Hello everyone and welcome back to Fun with Fitzy. Today's video is Chapter 4, Video 2, and we're going to be talking about closing entries, which is a bit of a review from grade 11. As a reminder, the purpose of closing entries is to update the owner's capital account in the ledger by transferring net income and owner's drawings to the owner's capital account. Because if you remember from the closing entries, you close revenue and expenses, which gives you your net income, and you close drawings, and they all end up getting closed to capital, and therefore the capital account gets updated. That's how the capital account gets updated, because we know on the balance sheet we do that formula, beginning capital plus net income minus drawings equals ending capital. So we know that on the balance sheet we update capital, but we actually have to update our ledger account so that in the next fiscal period we have the correct starting balance. And also, it prepares the temporary accounts, which is also known as nominal accounts. Remember, we call these nominal. And the nominal accounts are revenue, expense, and drawings. All of those accounts need to be closed, which means we're bringing them to a zero balance. Because next fiscal period, we want to start tracking our new net income and the amount of drawings the owner takes out. And if we have amounts in those accounts, then we're not tracking for a proper fiscal year. We want to start fresh. So those are the two purposes of the closing entries. Again, a reminder, temporary versus permanent. So temporary or nominal, we just talked about, are these accounts: revenue, expense, and drawings. Revenue, expense, and drawings. However, permanent accounts are not closed. They always maintain the same balance. So our assets, our liabilities, and capital never get closed. Okay, so those balance sheets accounts, all of the income statement accounts plus drawings get closed. You need to know that. Okay, so after you've done your closing entries, here's a little check. Does the balance in your owner's capital account equal ending capital reported in the balance sheet? And if so, you're in good shape. And are your temporary account balances zero after you've journalized and posted them? If not, you've done something wrong. Usually one of the mistakes that I see is people end up doubling those accounts. Okay, let's take a look at the process here. So here we have our worksheet that we just looked at in our last video when we looked at the adjustment entries on the worksheet. So closing entry number 1. Transfer the balances in the revenue accounts to a new nominal account called income summary. So basically everything in this credit column of your income statement you're going to close. Now I say that because last year, you'll know when we have merchandising companies, there's going to be a lot more information in there. So remember the acronym REID. R is the first one. And everything, you're just going to put a big box around this column of your worksheet, and anything in there is going to be closed because you're going to end up with merchandise inventory. You're going to take this, because it's a credit, you're going to debit it. So here's what it looks like. You're going to debit that account. Here it is. And you're going to credit the income summary. That's step 1. Step 2, and we know that our step 2 here is now E, expenses. Revenue, expense, income summary, drawings. So we're going to take everything in this column, because as you learned in grade 11, you're going to end up with other things in this column like merchandise inventory and sales returns and allowances. You're going to close them all in one big journal entry. So you're going to take every number in here and you're going to credit it. But your debit amount is going to be your income summary, and you're going to get that from the total down here at the bottom. So the $146,984.91 is debited right there, and then each one of these individually is listed on that journal paper. Remember to indent your credits. For our third journal entry now, the income summary, we're going to close our income summary, and you can find that information right here. In this particular case, we have a net income. Net income is good, and we want to increase our capital by that amount. So we're going to credit capital and debit our income summary. So there is our capital being credited and our income summary being debited. If this were a net loss, these two would be reversed, because if there was a net loss, capital would be going down. So you would debit capital and credit the income summary. And finally, we're going to close drawings. That's our last step here. The D stands for drawings, and we're going to find our drawings right here, $42,000. Because it's a debit, you're going to do the opposite and credit it. So there's our credit. Our drawings are being credited, and we're going to close it to capital. Okay, so a recap. Our 4 closing entries are REID, and you're going to close revenue, expense. Both of those get closed to the income summary. Then you're going to close income summary and drawings to capital. So all in all here, all of our accounts, this is the R, this is the E, here's the I, and the D, are 4 closing entries. Again, reminder, put your heading. Closing entries are year and the page number. Okay, one more reminder. Revenue was a credit, so you needed to debit it. Expenses are normally debit, so you need to credit them in order to get them to 0. In this case, income summary, there was a net income, so you need to increase capital because it was a net income, so you credit capital. And drawings is a debit, so you credit drawings. So those are the summary of our closing entries. By now, you should be able to explain why accountants need to close the accounts. There were 2 reasons. Be able to complete the closing entries using that acronym READ. And thanks for watching. Hope this helped.